Okay, so you want to own a bank. Sounds like the dream, right? People walk in, they hand you their money. You lend it to someone else at a higher rate. You collect the difference. You sit back. You get rich. That is more or less what a bank does. The problem is what it costs to actually do it, what happens when the math turns against you, and why some of the smartest people in finance have watched banks they built over decades collapse in a single afternoon. So let us start at the beginning, not with the vault, not with the interest rate. Let us start with something more basic, what a bank actually is. Most people picture a bank as a very secure storage room. You bring your money in, they guard it, you take it out when you need it. That is not a bank, that is a locker. A bank is a machine that turns other people's money into income-producing assets. Every dollar you deposit is not sitting in a box with your name on it. The moment it arrives, it starts working. Think about it this way. A bakery takes flour and turns it into bread. A steel mill takes iron and turns it into car parts. A bank takes your deposits and turns them into loans, bonds, and investments that generate income every single day. The raw material is other people's money. The product it sells is credit. And here's the part that makes banking genuinely different from almost any other business on the planet. When a bakery sells bread, the flour is gone. When a bank lends your deposit is still there. You can still see it when you log in. You can still withdraw it tomorrow. It has not gone anywhere as far as you are concerned. But the bank has also lent most of it to someone else. This is not fraud. It is fractional reserve banking, and it is the foundation of every modern economy. Here is how it works. You deposit $100 into a bank. The bank does not keep $100 in a vault. It keeps a fraction, lends out the rest, and operates on the calculated assumption that most people do not withdraw everything at once. For most of history in the United States, banks were required to hold 10% of deposits in reserve. So for every $100 deposited, $90 could be lent out. That $90 gets spent by the borrower. The person who receives it deposits it at their bank. That bank keeps $9 and lends out $81. And the cycle continues. $100 in original deposits eventually becomes somewhere between $900 and $1,000 circulating through the economy. This is not magic. It is math. And it is the reason why a modern economy can function without physically printing a new dollar bill every time someone wants a loan. In March of 2020, the Federal Reserve eliminated reserve requirements entirely in the United States. Today, banks are no longer required to keep any specific percentage in reserve. Instead, the Fed pays banks interest on the balances they voluntarily keep with the central bank, which encourages them to hold reserves without mandating it. The regulatory focus has shifted to capital requirements, which we will get to shortly, but the core idea remains the same. Banks operate on trust. The whole system runs on the assumption that not everyone will ask for their money back at the same time. When that assumption breaks, everything else breaks with it. So you want to start a bank. How much does it cost? This is where the first trap opens. You might think the answer is a lot of cash and a nice building. The real answer is that before you take a single deposit or make a single loan, you have already spent between $2 and $30 million, depending on what kind of bank you are building. And you have spent somewhere between 1 and 3 years filling out paperwork. The Federal Reserve describes the process this way. Starting a bank requires permission from at least 2 separate regulatory authorities. You need to apply for a charter, either a federal charter from the Office of the Comptroller of the Currency or a state charter from whichever state you are operating in. Then you need to separately apply for deposit insurance from the Federal Deposit Insurance Corporation, which everyone calls the FDIC. Both applications require extensive documentation of your business plan, your management team, your risk framework, your capital adequacy projections, and detailed information about everyone involved in running the institution. The FDIC does not approve banks that they think have a poor chance of surviving. So your application needs to demonstrate not just that you have money, but that you have a coherent and realistic plan for making the bank work. And then there is capital. Capital is not the same as deposits. Deposits are money you owe your customers. Capital is money that belongs to the bank itself, the cushion that absorbs losses if things go wrong. For large banks, the minimum capital requirement under current Federal Reserve rules is 4.5% of risk-weighted assets, plus an additional buffer of at least 2.5%. For smaller community banks, regulators typically look for a leverage ratio of around 9 to 10%. In practical terms, if you want to build a small community bank that can make $100 million in loans, you need to come in with roughly $10 to $15 million of your own capital before you start. That capital cannot be borrowed. It cannot come from deposits. It has to be yours. And that is before you lease a building, hire staff, build a technology system, buy compliance software, or pay the lawyers who will spend months helping you navigate the regulatory process. We have not made a single loan yet. We have not collected a single dollar of interest, and we have already spent real money to simply obtain permission to operate. Now you are open. And the costs are only just beginning. First, there are people. A functioning bank needs loan officers, compliance officers, risk managers, branch staff, IT personnel, cybersecurity teams, auditors, and senior management. For even a small community bank, payroll alone runs several $1 million a year. For a large regional bank, it is hundreds of millions. JP Morgan Chase, the largest bank in the United States by assets, spent more than $22 billion on non-interest expenses in a single quarter of 2024. That is expenses not including the interest they pay depositors. Second, there is technology. Banking is one of the most technology-intensive industries that exists. Every transaction needs to be recorded, verified, and secured. Fraud is constant. Cybercrime is constant. A single data breach can cost a bank hundreds of millions of dollars in fines, legal fees, and lost customers. Large banks now spend billions annually on cybersecurity alone. Third, there is compliance. Banking is among the most heavily regulated industries in the world. You have anti-money laundering rules. You have fair lending laws. You have consumer protection regulations. You have stress testing requirements. Every quarter, every year, you file reports with multiple regulatory agencies. The cost of employing enough compliance officers, lawyers, and audit staff to stay in line with all of this is staggering. For large banks, it represents one of their largest operating expenses. Fourth, there is the cost of bad loans. Every time a bank lends money, some portion of it will not come back. The borrower loses their job, the business fails, the real estate market collapses. Banks are required to set aside money in advance to cover these expected losses. These are called loan loss provisions. In bad years, those provisions can eat an enormous portion of what would otherwise be profit. Add it all together and the picture becomes clear. Even before you have earned $1 of revenue, a functioning bank carries enormous fixed costs that run every day, regardless of whether the loans are performing. Here is the mechanism. A bank's primary income comes from what is called the net interest margin. You borrow money cheaply from depositors, and you lend it expensively to borrowers. The difference is the spread. The spread is the engine. A basic savings account in the United States currently pays somewhere between 0.2 and 5% interest, depending on the bank and the account type. A car loan charges somewhere between 6 and 20%. A credit card charges even more. A mortgage charges somewhere between 6 and 8% for most buyers right now. The bank sits in the middle of all of this, collecting the difference. If a bank has a loan portfolio of $500 million and earns an average net interest margin of 3% on that portfolio, that is $15 million in annual income before expenses. Sounds decent, but subtract payroll, technology, compliance, insurance, deposit costs, and loan loss provisions, and what remains is the actual profit. But lending is not the only game. Banks have learned over decades to collect income from almost every transaction they touch. There are account fees, monthly maintenance fees, wire transfer fees, fees for cashier's checks and foreign exchange. Overdraft fees, which the Financial Health Network estimated generated nearly $10 billion in revenue across banks and credit unions in 2022 alone, have become one of the most scrutinized fees in banking because regulators view them as predatory. But they have also been profitable. There are interchange fees. Every time you swipe your bank's debit or credit card at a store, that store pays a processing fee. The bank takes a percentage. On billions of transactions, that becomes real money. There are investment and wealth management fees. Many banks now run asset management arms, advising wealthy clients on how to invest, and collecting fees based on the assets they manage. And for the largest banks, there is investment banking, helping companies raise money in public markets, advising on mergers, trading securities. JP Morgan's investment banking revenue jumped 49% in the fourth quarter of 2024. In that same year, JP Morgan Chase earned a net profit of $58 billion. The highest annual profit in the history of American banking, $58 billion. That number exists because of scale. The spread on any individual loan is small. When you multiply it across trillions of dollars of assets, small percentages become inconceivable sums. Here is what makes banking genuinely unusual as a business. Most businesses use their own money or borrowed money to generate returns. A restaurant owner puts in capital, buys equipment, hires staff, and hopes the margin on food is enough to pay back the investment. A bank operates almost entirely on other people's money. The deposits sitting in your customers' accounts are the raw material. You borrow those deposits at low rates, lend them at higher rates, and the return you generate is on capital you do not own. This is what bankers call leverage, and it is both the source of banking's extraordinary profitability and its extraordinary danger. When a bank earns 1% return on $500 billion in assets, that is $5 billion. On its actual equity capital, the money that belongs to the bank, the return on equity might be 10, 15, or 20%. JP Morgan's return on tangible common equity in 2024 was roughly 22%. Practically no other industry in the world generates returns like that on a sustained basis, but leverage works in both directions. When assets lose value, when loans default, when bonds fall in price, when markets seize up, the losses are not absorbed by depositors first. They come straight out of that small layer of equity capital. A bank with $50 billion in deposits and $5 billion in capital only needs to lose $5 billion before it is technically insolvent. That $5 billion is only 10% of what it owes. This is the trap at the center of banking. The thing that makes it so profitable is precisely the same thing that makes it capable of collapsing so fast. Meet Kerry Killinger. He was the chief executive of Washington Mutual, which people called WAMU, for 17 years. By 2007, WAMU was the largest savings bank in the United States. It had over 2,200 branch offices across 15 states, 43,000 employees, and $188 billion in deposits. Kerry Killinger had built it from a regional institution into a national giant. He understood mortgages. He understood retail banking. He understood his customers. But WAMU had done something that looked at the time like a reasonable business decision. It had pushed aggressively into the subprime mortgage market. These were loans to borrowers with poor credit, charged higher interest rates to compensate for the risk. The logic was that the extra interest income more than covered the extra defaults. And for years it did. Then the housing market collapsed. Home prices had been rising for years. When they started falling in 2006, borrowers who could no longer afford their payments had no equity left to sell the house and pay off the loan. Defaults began to pile up. WAMU's loan portfolio started hemorrhaging value. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history at the time, involving more than $600 billion in assets. The news hit financial markets like a physical blow. WAMU depositors panicked. Over the next 10 days, they withdrew $16.7 billion from WAMU's accounts. That was over 11% of the bank's total deposits. The Federal Deposit Insurance Corporation said WAMU had insufficient funds to conduct day-to-day business. On September 25, 2008, regulators seized Washington Mutual and sold it to JP Morgan Chase for $1.9 billion. A bank with $188 billion in deposits sold for less than $2 billion. The bondholders lost roughly $30 billion in their investments. The shareholders lost nearly everything. But here is the more important question. How does a man who built a bank over 17 years, who understood the mortgage business intimately, end up presiding over the largest bank failure in American history? The answer is not personal incompetence. The answer is structural. Washington Mutual's problem was not unique to WAMU. The entire American banking system had developed a dependence on rising home prices to make the loan math work. When prices stopped rising, the loan math stopped working. And when one major institution collapsed, the fear spread to every institution, not because they were all failing, but because nobody could tell which ones were next. This is the central risk in banking. It is not just that your loans might go bad. It is that confidence itself is fragile. A bank can be technically solvent one morning and facing a fatal run of deposit withdrawals by afternoon, not because anything changed in the underlying business, but because enough people decided simultaneously that they were worried. Silicon Valley Bank had $209 billion in total assets as of December 31, 2022. It was the 16th largest bank in the United States. It had been operating for 40 years. It was gone in 44 hours. The story is almost mechanically simple. Silicon Valley Bank served technology startups and venture capital firms. Between March of 2020 and March of 2021, its deposits doubled from $62 billion to $124 billion. As the technology sector boomed and cash flooded into the startup world, SVB took much of that money and invested it in long-term government bonds, which paid higher interest rates than short-term instruments. This was not reckless. Government bonds are the safest investment in the world. The problem was the duration. Long-term bonds lose value when interest rates rise. When the Federal Reserve began raising interest rates aggressively in 2022, the fastest rate increase in 4 decades, the value of SVB's bond portfolio fell dramatically. By the end of 2022, SVB was sitting on roughly $17 billion in unrealized losses on a bond portfolio it was treating as though it would hold forever. At the same time, the tech sector was contracting. Startups were burning cash and making withdrawals. SVB's deposit base was shrinking at exactly the moment its bonds were worth less than it had paid for them. On March 8, 2023, SVB announced it had sold $21 billion of its investment portfolio at a loss of $1.8 billion and was trying to raise more capital. That announcement triggered what happened next. Venture capitalists who had invested in SVB's clients began texting each other. Group chats went live. Peter Thiel's Founders Fund pulled all of its money out. Other firms followed. By the close of business on March 9th, customers had attempted to withdraw $42 billion in a single day, nearly a quarter of the bank's entire deposit base. SVB had a negative cash balance of $958 million. It could not function. On March 10th, the California Department of Financial Protection and Innovation seized the bank. The Federal Deposit Insurance Corporation became the receiver. Employees received their annual bonuses that morning, hours before the government took control. What destroyed Silicon Valley Bank was not bad loans. It was interest rate risk. The gap between the value of assets on paper and their value in a rising rate world, combined with a depositor base so concentrated and so well connected that when fear spread, it spread at the speed of a text message. The Federal Reserve's own review, published in April of 2023, concluded that SVB's management had mishandled the interest rate risk, that the board had failed to provide adequate oversight, and that federal supervisors had been too slow to act on warning signs they had identified. The system failed at multiple levels simultaneously. You have your bank, you have your staff, you have your loans, you have your fees. Your net interest margin is healthy. The math, on paper, looks reasonable, and then interest rates move. This is the variable that sits beneath everything else in banking. The Federal Reserve sets the federal funds rate, which is the overnight rate at which banks lend to each other. That rate influences nearly every other interest rate in the economy. When it rises, the cost of deposits rises. When it falls, the income from loans falls. Banks try to manage this through what is called asset liability matching, essentially trying to ensure that the time horizon of your assets, meaning your loans and investments, roughly matches the time horizon of your liabilities, meaning your deposits and borrowed funds. If you have mostly short-term deposits and you put them into 30-year mortgages, you are exposed. If rates rise, your deposit costs go up immediately. Your mortgage income does not, because those loans are locked in at the old rate. This mismatch is not always obvious. It does not always look dangerous. Washington Mutual looked fine until it did not. Silicon Valley Bank looked fine until it did not. The math of banking is heavily influenced by factors that are set by a committee in Washington that meets 8 times a year and can change the entire economic environment over the course of a few months. That is the volatility trap at the center of the business. The revenue model works in the right conditions. The conditions are not always right, and they can change faster than any bank is built to handle. Let us say you have done everything correctly. You have raised $15 million in starting capital. You have your charter and your deposit insurance. You have opened your doors. You have built a loan portfolio of $100 million with a net interest margin of 3%. You collect $3 million a year in interest income before expenses. Add in fee income from accounts, wire transfers, and card processing. Your gross revenue is $3.7 million. Now subtract. Payroll for a bare minimum team of 15 people, $1.8 million. Technology and core banking software, $400,000. Compliance and legal, $300,000. FDIC insurance premiums, $80,000. Loan loss provisions for a reasonable expected default rate, $300,000. Physical space and overhead, $200,000. Total expenses, $3,080,000. Net profit, roughly $620,000. To recoup your $15 million starting investment at that rate, you are looking at somewhere around 24 years. And that is the good scenario. Now the bad scenario. Interest rates rise by 2 percentage points while half your loan portfolio is locked in at fixed rates. Your deposit costs go up immediately because depositors move money to wherever rates are higher. Your net interest margin compresses from 3% to 1.5%. Your interest income drops from $3 million to $1.5 million. Your expenses stay the same. You are now losing money every month, or a recession hits. The unemployment rate rises. Borrowers start defaulting. Your loan loss provisions, instead of $300,000, are now $1.5 million. You are losing money every month. The difference between a good year and a bad year can be $2 million on a bank of this size. In absolute terms, that sounds manageable. But remember, your entire capital base is $15 million. 2 bad years in a row, and you have consumed 27% of your cushion. 3 bad years, and regulators are asking questions. Banking is one of the most consistently profitable industries in the history of commerce when it works. JP Morgan earned $58 billion in a single year. The largest families in European history chose to own banks rather than factories because they understood something that is still true today. When you sit in the middle of money flows, you collect a toll on almost everything the economy does. But banking is also the industry that has produced more spectacular collapses, more catastrophic losses of other people's money, and more government rescues than almost any other business in human history. The reason is always the same. The business runs on leverage. Leverage amplifies everything. It amplifies the good years and it amplifies the bad years. And the bad years in banking do not arrive slowly. They arrive in 10 days of deposit withdrawals. They arrive in 44 hours. They arrive on the morning that a venture capitalist sends a message to a group chat. Washington Mutual had $188 billion in deposits. It was gone in 10 days. Silicon Valley Bank had $209 billion in assets. It was gone in 44 hours. Both of those banks were run by experienced people who understood the business. Both of those banks had survived decades of previous crises. Both of those banks were profitable right up until the moment they were not. So if you do decide to own a bank, understand what you are actually buying. You are not buying a vault. You are not buying a stable, predictable income stream. You are buying a machine that turns trust into money and runs entirely on the assumption that the trust never runs out. The moment it does, no capital buffer in the world moves fast enough.